Walk into Terminal C at Charlotte Douglas International Airport. It is 8:15 a.m. Over the next 60 minutes, more than 60 American Airlines and American Eagle jets will touch down on the concrete outside. 45 minutes later, those exact same passengers will board different aircraft. The planes will push back. The gates will empty. More than 120 total aircraft movements will have been orchestrated in a single hour. The entire cycle repeats itself 2 hours later. American Airlines controls 90% of the flights leaving this facility. Watch the passengers. Nearly 80% of the people boarding these planes are just passing through. Fewer than 1 in 5 actually start or end their journey in North Carolina. Charlotte is not a traditional airport. It is a high-speed connection factory. Commercial airlines do not operate simple point-to-point networks. Flying a mainline 150-seat jet directly from Dayton, Ohio to Savannah, Georgia, guarantees empty seats and financial losses. The industry solved this nightmare decades ago by building the hub-and-spoke model. Airlines route smaller regional flights into centralized choke points. They combine passengers bound for dozens of global destinations onto highly efficient departing flights. American Airlines weaponized this strategy. Routing millions of people through a single geographic point manufactures a localized monopoly. The footprint is staggering. This single hub generates $31 billion in economic output for North Carolina. It single-handedly supports 147,500 jobs statewide. To the governor and state senators, American Airlines is an indispensable public utility. Allowing this airline to collapse into a disorderly bankruptcy would trigger massive regional downsizing, immediate route cuts, and localized recessions across North Carolina, Texas, Florida, and Pennsylvania. Management understands this structural guarantee. The implicit federal backstop encourages reckless financial engineering. Executives know they can load the balance sheet with debt because they know the government cannot afford the political fallout of a major hub shutting down. In 2013, the United States aviation industry entered a golden age. Widespread mergers reduced the market to 4 major players. Cutthroat price wars ended. Ticket prices stabilized. Jet fuel costs plummeted. Cash flooded the corporate treasuries. Competitors like Delta and United deployed their cash into the physical product. They upgraded lounges. They refreshed wide-body fleets. They elevated the premium cabin experience. American Airlines bought its own stock. Between 2014 and 2019, the executive team authorized 7 separate share repurchase programs. They executed this strategy relentlessly. American Airlines spent $12.4 billion to buy back 312.7 million shares at an average price of $39.76. Combined with ongoing dividend payouts, the company returned $12.959 billion to shareholders in 5 years. Compare that to their civic contributions. During that exact same window, American Airlines paid just $1.729 billion in corporate taxes. Management channeled 7.5 times more cash into the hands of private investors than they paid to the federal government. Operating cash flow could not sustain this extraction. The airline took on billions in new debt to fund the buybacks. They intentionally leveraged the balance sheet during the most prosperous years the industry had ever seen. Total debt reached $34.02 billion by the end of 2018. They sacrificed structural durability for short-term stock manipulation. Saddled with that debt, management needed cash. They sought ruthless cost-cutting measures inside the aircraft cabins. They launched an initiative internally dubbed Project Oasis. The objective was absolute density. Engineers crammed more seats into the existing fleet. On their Boeing 737s, the configuration had already been pushed from 150 up to 160 seats in a previous retrofit. Project Oasis squeezed them further, driving the capacity to 172 seats to perfectly match their incoming MAX fleet. Finding room for those final dozen seats inside a fixed aluminum tube required millimeter-level adjustments. Management planned to reduce standard coach seat pitch down to 29 inches. That dimension previously existed exclusively on ultra-low-cost carriers like Spirit and Frontier. Public outcry forced a slight retreat, but the airline still compressed the cabin layout well beyond traditional legacy carrier standards. The padding was thinned out. Because the airline desperately needed the revenue generated by premium extra legroom seats, they forced the spatial sacrifices entirely onto standard economy passengers. They shrank the lavatories. The newly installed bathroom doors physically banged into one another. The microscopic sinks sprayed water back onto passengers' shirts. Seatback entertainment screens vanished from domestic flights. This strategic error compounded rapidly, degrading the economy experience, alienated high-paying, frequent flyers. The airline chased the budget traveler demographic while carrying the fixed operating costs of a legacy network carrier. Competitors offered superior hard products. Delta and United captured the highest margin traffic and cemented passenger loyalty. American Airlines offered an ultra-low-cost experience at legacy pricing. Spring 2020. A novel coronavirus halts global mobility. Passenger demand plunges to zero. Revenue vanishes overnight. The fragile financial architecture collapsed entirely. American Airlines held almost no cash reserves to weather the shock. They had just spent $12.4 billion buying their own stock at nearly $40 per share. Desperate to survive the daily cash burn, management flooded the market. Between June and the end of 2020, they issued over 181 million new shares at roughly $12.50 apiece. They were panic selling the exact same equity they had just spent billions buying at $40. The outstanding share count skyrocketed. Shareholders suffered severe, permanent dilution. The strategy engineered to boost the stock price ultimately destroyed billions of dollars in real value. Private capital markets alone could not fill the cratering revenue gap. The aviation industry mobilized a lobbying effort in Washington. Executives deployed the regional monopoly argument. Letting the carriers fail would sever connectivity to smaller airports and trigger hundreds of thousands of immediate layoffs. The United States government capitulated. The initial CARES Act injected $50 billion directly into passenger airlines. But the bailouts didn't stop there. Across 3 successive federal relief packages, American Airlines secured over $10 billion in total grants designated strictly for payroll support, and negotiated an additional $4.8 billion federal loan to fortify its liquidity. The bailout validated the precise theory dictating the airline's pre-pandemic financial strategy. The hub and spoke model cemented the carrier's political invulnerability. Taxpayers absorbed the shock of the pandemic. Even with the federal bailout, the airline required infusions of private capital to maintain operations. Securing this capital required the airline to pledge its most valuable physical assets as collateral. Management mortgaged takeoff and landing slots. They mortgaged international route rights. They mortgaged aircraft spare parts. When the hard assets ran out, they mortgaged their intellectual property. Management utilized the A-Advantage frequent flyer program to secure multi-billion-dollar term loans. The A-Advantage loyalty program functions as a highly lucrative internal bank. Members earn miles not just by flying, but through co-branded credit cards and non-flight partners. Banks purchase these miles directly from the airline to reward credit card users. They pay in hard cash. This generates predictable streams of high-margin revenue. Wall Street analysts routinely value the A-Advantage program at roughly $24 billion. The market capitalization of the entire airline is often less than $10 billion. The loyalty program is literally worth more than the planes. By pledging this cash flow as collateral, American Airlines secured the financing necessary to survive. But they shackled their most profitable division to restrictive debt covenants. The notes and term loans secured by the A-Advantage program include peak debt service coverage ratios that rely entirely on the cash flows generated by consumer credit card spending. The airline essentially operates a bank that happens to fly planes. The combination of pre-pandemic corporate borrowing and emergency pandemic loans pushed the balance sheet to the breaking point. In 2021, total debt peaked at an apocalyptic $48 billion. The airline owed more money than the total value of its physical assets. They operated with negative shareholder equity. Facing this $48 billion mountain of leverage, CEO Doug Parker introduced the Green Flag Plan in early 2021. Management established a highly publicized target: reduce total debt by $15 billion by the end of 2025. The strategy yielded rapid results. In 2023, American Airlines reduced total debt by $3.2 billion. They ended the year with the highest free cash flow in company history at $1.8 billion. In 2024, the airline generated a record $2.2 billion in free cash flow, deploying the capital to eliminate liabilities. In the fourth quarter of 2024, American Airlines officially achieved its $15 billion debt reduction goal, crossing the finish line a full year ahead of schedule. The aggressive paydowns brought the total debt down to $36.5 billion, and recent filings show the company actively shedding leverage down to roughly $34.7 billion. Management successfully diffused the immediate threat of bankruptcy. Escaping the absolute peak of the mountain, however, did not cure the underlying disease. Reducing debt by $15 billion prevents immediate collapse, but a $34.7 billion burden guarantees permanent structural weakness. The cost of carrying this leverage acts as a relentless anchor. In 2021, their interest expense was $1.8 billion. By 2024, despite aggressive paydowns, the compounding rates meant they were still bleeding nearly $2 billion a year in pure interest. The airline operates an entire global network merely to hand over billions of dollars to bondholders and banks. You can see the bleeding directly on the income statement. Recent full-year data shows American Airlines generating an astonishing $53 billion in total revenue. But after covering fuel, maintenance, and those crushing interest payments, their adjusted operating margin struggles to break 5%. The financial structure is so fragile that a single $985 million contract ratification bonus paid out to their pilots dragged their net margin for the year down to a microscopic 1.5%. The company clears barely over a single cent in profit for every dollar it makes from the actual physical transportation of human beings. Labor pressures compound the margin squeeze. During the post-pandemic recovery, the Allied Pilots Association successfully negotiated new contracts. Management agreed to substantial compensation increases, matching the lucrative deals secured by pilots at Delta Airlines. The new labor agreements significantly raised the airline's break-even point. Without the premium revenue generation of its rivals, American Airlines assumes the high fixed costs of a legacy carrier without capturing the high-margin yields necessary to sustain them. This financial rot is creating an all-out war with the workforce. Delta Airlines routinely pays out over $1 billion in profit sharing to its employees in a single year. That single bonus pool, reaching $1.4 billion for 2023, massively surpasses Americans' entire full-year corporate earnings. Desperate to cut distribution costs, management aggressively overhauled their corporate booking strategy, restricting how agencies could buy tickets. It backfired spectacularly. Corporate travel managers simply routed their highly profitable business flyers onto Delta and United, structurally damaging Americans' highest margin revenue stream. These failures exposed a blind spot in where the airline actually flies. As the pandemic receded, travel patterns shifted dramatically, and demand for premium transatlantic travel surged. Delta and United capitalized immediately, deploying their wide-body aircraft on lucrative routes to Europe to drive billions in profit. American Airlines missed the wave. To save cash during the pandemic, management aggressively retired dozens of their older wide-body jets, assuming new Boeing 787s would replace them. When manufacturing defects forced the FAA to halt 787 deliveries, American was caught without the heavy metal. Constrained by a lack of capital, a crippled supply chain, and an inherent weakness in critical coastal markets, the airline watched its competitors capture the highest margin traffic in the industry. The financial markets recognized the grim reality. Despite the $15 billion debt reduction, the stock price languishes. An investor who purchased American Airlines stock when it relisted after its 2013 merger has watched their investment underperform the broader market for over a decade. The company continues to trade heavily leveraged, burning cash to tread water, while attempting to convince Wall Street that the turnaround holds momentum. American Airlines is a corporate paradox, a global economic engine bordering on insolvency. Their $48 billion debt crisis in 2021 wasn't an accident. It was the result of burning $12.4 billion on stock buybacks instead of improving their product. When the pandemic hit, they were bailed out simply because their massive regional hubs made them politically too big to fail. Today, American operates like a zombie corporation. Even after reducing their debt to $34.7 billion in 2026, crushing interest payments act as a permanent tax. With razor-thin margins and a compromised product, the airline now flies just to service its debt. It relies on its A-Advantage credit cards to generate cash flow, while its rivals pull further into the distance. A corporation can be too big to fail, but it's never too big to pay the price for its own financial greed.